What's next for the markets? Is this merely just a pullback, a dip that should be bought, and then off to the races again? Or is this something new? Are we about to go into maybe a bear market? I hope you will indulge me these few minutes. It might save you your retirement. It might save you hundreds of thousands, maybe millions of dollars that you have accumulated in these markets over the last 20 some odd years. First, let me introduce myself in today's date. It is Friday, March 28th at about 10 p.m. My name is Don Marshall, otherwise known as Bag of Don at StockMarketCaddy.com. And yes, we are active traders. We trade the markets day in and day out and have been doing that for decades. You see, the way that we trade, it really doesn't matter to us how high the market goes or how low it goes. We trade the money flow, extracting cash flow. But you may be a long-term investor. So for you, I have brought to life a chart of the S&P 500. This is the $SPX.X, the S&P 500. 500 of the most important corporations, not just in the United States, but in the world. The market, the index that the pros pay attention to, because everything else hinges off the S&P. If the S&P 500 are not doing well, the NASDAQ and the Russell and nothing else will be doing well. It is what generates a wealth effect, and it can be what generates a recession. Let me show you something. This is where we are today, right here. This is a 3-line break monthly chart, and this is the month of March. And it is about to confirm on April Fool's Day a reversal signal on a monthly basis. What might that mean? Well, let's go back in time and show you a couple of other periods. Do you see this right here? This was in 2000, in August of 2000, the height of what was also the .com or the NASDAQ bubble. And then in March of 2009, the market started down. 9 months later, may not look like much to you, but the NASDAQ was down 90%. 90%. The NASDAQ went from 5,000, while the S&P pulled back some 60-70%, but the NASDAQ fell from 5,000 to 900 in 9 months. This little move here, up here, was the bull run in 2003 to 2008. You see this little move here? Another big crash. They said it rivaled 1929. It was the 2008 crash. Not just here in the States, but around the world. Pretty significant events, especially if you were about to retire right here or retire right here. And then the markets lit off in March of 2009 as they launched with President Obama, newly elected, quantitative easing, engineering what we have today, a market bubble. This was QE1, QE2, QE3, QE4, Operation Twist. This was COVID, and then QE again. Everybody stay home. We're going to send you money, and off to the races we go. This is now March of 2025, and we're about to close. So you may think that's just a pullback. We'll go higher, certainly. Well, we might. But Let me show you something. There's something in technical trading called Fibonacci retracements. And I'm going to grab it right here. And we're going to grab the obvious low right here, 2008, and take it up to the obvious high right here. If this is the start of a pullback, the likelihood is that we will pull back into this area right here. I'll put a line there. There it is right there. This would bring the S&P down to 4,004,002. From 6,000 to 4,000. Entirely possible. In fact, most advances retrace, especially when they're outsized, 50%. Where would that be? Let me show you. We're going to increase the weight. Let me change the font so you can see it. I'll make it magenta. And we'll even try to make the label bigger so that you can see it. Let's see if I can edit the size. Here it is here. We'll edit the size. Bear with me. And we'll make it nice and big. There they are. This level, very likely, most likely, 33.75. And folks, if they panic, if all the people that are in here begin to panic here, we could do what happened over here and here. Yes, we could come down 61%, 27.48. We could come back down 76% to 1973. 1973. Not the year. It may feel like it, but in price, it's possible. Are you taking precautions now? It just started. From here to where we are now is just a 10% decline. If we fall 50%, you have to understand that many companies may fall individual 70, 80%. They may in fact go out of business if they're living on borrowed money and they can't survive what in essence will come, because when the market is going up and up and up like this, it's the wealth effect. Everyone's buying houses, everyone's buying cars, everyone is spending. When the market corrects, there'll be less spending. There's the reverse wealth effect. And there's a crazy thing. If the market comes down 50%, as an example, it needs to go up 100% to get back to even. Now, this could take months to unfold, but it could take years to restore or come back to that level, as it did over here. When the dot-com crashed in 9 months, the NASDAQ took 10 years plus to get back to where it was. And many of the individual companies that were part of the NASDAQ never came back. And if we don't have any new companies with new technologies, then we might just go sideways. Can that happen? Absolutely. From 1966 to 1981, I was going to say in that area, the S&P ended where it started. The only people who made money in the markets were the traders. I wish you the best. I invite you to visit Stock Market Caddy, CADDIE.com. You're welcome to email us. You're welcome to call. any day. You can reach me at 813-758-8263. Time to buckle those chin straps, folks. Good luck.